Welcome back, my friends. We've got some good news and we've got some bad news. The good news is inflation has come off of its peak. The bad news is we are likely heading for a massive recession. Let's dive in. Today we're going to cover the market action from a high-level overview, sectors, individual names, and then we're going to go over some charts. Our heat map really says it all. The color of the day is red. And what is so noteworthy about this sell-off in comparison to the others early on in the year is that earlier on in the year, it was an issue of inflation. It was like, oh my gosh, energy prices are moving too high, and that is putting upward pressure on rates, and that's causing the market to sell off. This is totally different because energy is actually one of the leaders in the decline. We're actually getting a rally in treasuries, as you can see here from our TLT long bond ETF, but we're still getting that sell-off in equities. For our box scores, we had the S&P 500 finishing down 1.44%. Another big loser, the NASDAQ, down 2.07%. Small caps down about 1.5%. Dow Jones, best performer, down only 1.05%. And of course, the ARK Innovation ETF got whacked, down 4.02%. Now, what is a little bit concerning on this sell-off in particular is that, sure, we're getting an expansion in volatility, as you can see here, but it's not like volatility is exploding out. So there's no evidence saying that this isn't the beginning of a much bigger sell-off. Our trend model did flip to a -3 reading, and our up volume registered at 29.4% for today's session. It was pretty much a sector bloodbath. Our KWEB China Technology ETF did finish out positive, up almost 2%. Gold miners were pretty much flat, and utility stocks were up 0.62%. We had huge unwinds in the MSOS Cannabis ETF, as well as energy, which has been developing. And our worst performing style factors were the high beta style factor and the growth style factor. So that's not what we want to be seeing, team. Today we had our fourth consecutive red candle for the S&P 500, and we are just tearing through downside support levels like a knife through butter. You can see over the last couple days, we lost the top of the monthly value area, we lost the 200-day SMA, and now today in one fell swoop, we lost the 20-day simple moving average, and we also lost the monthly point of control. Now, this is important for two reasons. One, the 20-day simple moving average is a very important level for trend followers. So the fact that that level was just cut right through, we closed below it, that is certainly not good in the technical picture. And then also, our realized volatility is just beginning to creep up, and there are vol control funds that will start to sell equities as volatility picks up and moves higher. So now here we are, we're pretty much in no man's land below this monthly point of control. On our hourly chart, we also lost this bottom of the weekly value area. So it's pretty obvious we are in the midst of a sell-off, and that's all we know. We just know sellers are present. I think if we learned anything from the sell-off that happened in the fall, that was like a 40-day sell-off. We never know, once those sellers are out, when they are going to disappear. A lot of times selling can really just turn into a domino effect where you get some sellers and other players go underwater, they start selling, and it really cascades, and we don't have any contrary evidence right now. The NASDAQ also sliced right below this monthly point of control and the 20-day simple moving average. The Russell 2000, which had already lost the 20-day SMA yesterday, traded down to this monthly value area low, and we're pretty much right on that 50-day simple moving average. And the Dow Jones lost the 20-day SMA and is trading right at that monthly point of control. The ARK Innovation ETF sold off right down to this monthly value area low. And this is all occurring as crude oil is incredibly weak. We finished out at $74.47 a barrel. Remember, when the market was originally selling off, crude got all the way up to $130 a barrel. And it was interesting. It was like, okay, the whole market's doing pretty bad, but we've got these energy stocks, these commodities doing well. So there was a hideout in the market. Now it appears that there's really no hideout. The only hideout is treasuries. Now, could this be occurring because investors think a big recession is coming? Absolutely. I mean, crude oil, there's no other reason why it would be moving so much lower than if investors really just thought that demand was going to come down drastically. If we do end up getting a recession, we will have this very awkward window of time where the economy is getting really bad, earnings are declining, but we are still in this environment where the Federal Reserve balance sheet is still rolling off and interest rates are still high. Investors might be preparing themselves for that kind of event in Q1 or Q2 of 2023. So perhaps they're just, clearing off the books a little bit, selling things off. There's also a lot of investors that are significantly underwater this year. Perhaps they're just closing things down for the year. Who knows? We mentioned yesterday that it was pretty tough to get on board with this MSOS rally, even though we had 3 pretty good days on high relative volume. And sure enough, that just completely came undone today. As active traders, we have the luxury of being able to sit on the sidelines and waiting for premium hands to trade the market. You have to be objective. And when you see all these yellow flags, like just breakdowns left and right, I'll give you another example. We had the MSOS. Take a look at some of the leading stocks like AEHR. This one, we had a beautiful trade here. We got long AEHR at about $15 and change. And we rode this one all throughout this breakout. And we started piecing out of the stock as it continued to drift higher. We closed our final piece right here, somewhere around like 25 or 26 bucks. And this one just absolutely rolled over. This is a prime example of why you can't buy stocks after they get too extended, because we wiped out weeks of price action in a single session. Another big breakdown for today was Enphase. Enphase finished down 7.77%. We were long this stock into this breakout right here, but I had this feeling in the back of my mind that it might be too good to be true, because the stock was trading at about like a 63 times forward earnings ratio. So it was just a little bit pricey. This stock has had a really good run throughout the year, but it just seems like this thing is kind of running out of gas. Lululemon is a name that has not fully given up the ghost. We got to pull back to the 10-day EMA. This could potentially be a stock to watch in case things get a little bit better into the end of the week. And SMCI, this company showed some really nice relative strength today, and it finished up 3.56%. Now, if this was like a really nice bull sequence, I'd be like, all right, I'm buying SMCI. This is awesome. But we have to remember, this could be the beginning of a bigger sell-off. We really don't know. And one of the worst things that you can do is buy high relative strength names as the market is beginning to leg lower. I've done that before. That's how I'm speaking from experience here. And a lot of times, if you do that, you could just end up buying the next group of stocks to roll over. Now, there is a silver lining. The silver lining scenario is that the PPI report, which is coming out on Friday, now at this point, that's only 3 trading sessions away. If that comes out light, that could perhaps provide some relief for equities. The last huge extended range green candle we had for the S&P 500 happened as we got light PCE data for the month of October. And this huge extended range green candle came in as I believe it was either the CPI or the PPI for the month of October. On Friday, that marks the beginning of the November inflation data. Our Trueflation dashboard continues to move to lower and lower year-to-date levels. Right now, we're at a 6.16% reading. The highest year-to-date level was 12%. This is showing us that inflation is decelerating. But my concern is that pretty much this whole year, lighter than expected inflation reports have been great, right? They've led to counter trend rallies. It's been awesome. But my fear is that we get a lighter than expected PPI. It's already been priced in because the market has moved, 10 to 20% off the lows. And the market just goes, all right, I'm going to sell into that PPI because I know there's a recession coming. That said, I do believe the reward to risk ratio is going to be better the more we sell off into the event. Heading into tomorrow's session, we have more questions than answers, right? We have charts that are breaking down. We have a VIX that has yet to explode, and we've got a binary event coming down the pipe. The one big mistake a lot of traders make is that when they feel like the environment's very ambiguous, instead of just going, it's a pretty ambiguous tape, I'm just going to trade less and do less, they do the opposite and they go, all right, the indicators I watched, they're pretty ambiguous. Let me look for other indicators and let me go on social media and see what people are saying. Let me see if there's someone smart enough that knows the answer of what the market is going to do next. A lot of times you just end up getting caught up in a bias. You seek out information that confirms what you already thought was to be true, and you can get yourself in a tizzy. A day like tomorrow could just be great for working on your process, honing your trading setups, doing some coding. That's likely what I will be doing. With that said, thank you so much for watching this video. If you enjoyed it, feel free, go ahead, click the like button on the video and subscribe to the channel. We really appreciate your support, and we'll see you all next time.